Happy Friday, June 5th. Welcome to another exciting edition of Rate Desk. I am your host, Michael Thomas, here to talk about multifamily, interest rates, and other news. Jump into the markets. What an exciting day today. Nobody saw the 2.5 million jobs added in May coming. As a result, the markets are up today pretty considerably. The Dow is up 3.2% at the close. NASDAQ and the S&P 500 are tracking near historical trends and highs. Really incredible to see that. Talk about a V-shaped recovery. I mean, you could argue that case today. Not all the analysts or traders are believing in this market for the long term. However, there's no denying that we are seeing the markets move pretty rapidly up today. We did see the crude oil also break up, and at one point early in the trading session, it was at 39 on the futures of crude per barrel, but it settled at the $38 range. Still up. Day over day, week over week, we're seeing that trend moving up, which is good to see. 10-year U.S. Treasury yield is kind of volatile today as well. We saw the trading session start around 92 basis points, 0.92. We ended today around 0.83. That's 83 basis points. So about 5-6 basis points up from yesterday. But down a little bit from where it was in the morning, which is really making me think we're going to break into that 1% range, which we haven't seen that for a little while. So interesting times. We are seeing a little bit of an uptick on the FHA rates. Going over to that desk, we're seeing the 223F now up, pricing at 265. That's 2.65 fixed for 35 years, and the 221D4 rate, new construction sub rehab, that loan is pricing at 330 today, 3.30. Spoke with my friend John Hender over at Walker Dunlop today. He is seeing some really good pricing exceptions on certain deals, and as a result, their pricing is more competitive. So seeing a pretty big downtick, again, a lot of it due to the fact that the agencies get hungry for volume for the right deals. They will drop their rates down. So seeing rates over there on the Fannie Mae desk at 285, 2.85 on 10-year money. Freddie Mac off the rack, still quoting at 320. Again, pricing exceptions. They want to see the deal to get an accurate quote, but that's still just kind of off the rack pricing there. So again, Fannie Mae, that's very competitive. Again, seeing certain exceptions for low LTV, market size, and all that good stuff. So you can get pretty aggressive there. Jumping on over to the other news category, some stuff that I wanted to speak with you about today. Did receive guidance on a loan that is recommended moving forward in the HUD FHA insured world. Want to just point out a few things, again, as strong mitigants in this market. One is clearly liquidity. If you have liquidity, that goes a long way to meet concerns regarding property occupancy or any problems that may arise. Another is the strong cash flow of the property. If you start out at a pretty strong debt service cover ratio, you have a much better chance of getting a loan approval in this environment. If you're kind of eking out just at the minimum required DSCR to get a loan done, gonna be kind of tough on that front. And then third, and last but not least, certainly is the property management piece. Got to have strong property management. We all know that. It's where the rubber really hits the road, especially in these times. So want to see those vacancy numbers controlled. Want to see those move outs explained. Want to have payment plans in place. Want to see those delinquencies stabilized or heading down and in the right direction. Those are just some of the key mitigants to consider when you're pursuing HUD FHA financing or really any other kind of secondary market financing. Those are definitely best practices in the loan arena. Specifically on the 223F, I wanted to cover a few of the escrows that are being required in addition to the regular escrows you would have for your replacement for reserve and your mortgage insurance premium. Those are just kind of standard out of the box on every HUD FHA insured transaction. But in today's environment, you're going to have a non-critical repair escrow, which, again, sorry, that's an out-of-the-box one. That's nothing new. But the new ones are a 9-month debt service cover reserve. That's your MIP, your mortgage insurance premium, plus your P&I times 9, right? Monthly times 9. Want to see that set aside. Going to want to see the number in your non-critical repair escrow. Remember, these are all the repairs that are identified, need to be completed within a year of closing. 250% multiplier on top of that. That's just an additional cushion. HUD wants to see that sitting on the sideline. Those are really the only two additions. The only other escrow you're going to have, if you have non-critical repairs, you're going to have an assurance of completion. Whether it's affordable or market rate, it's going to be somewhere between 10 and 20% on your AOC, your assurance of completion escrow. Last thing I want to mention today, HUD came out with the statutory increases. If you remember, we spoke about these statutory limits HUD sets on loans, and it affects the per cost that you're allowed to finance unit by unit, unit type by unit type, and you get to use a multiplier based on what market it's in. So I reviewed it today. It's effective back to January. No major changes there. The big addition that I saw is the 315% multiplier now says that can be utilized on a case-by-case basis where necessary. I bet you the lenders in New York and California and even in Denver, where we only have a 270% multiplier, say it's necessary. So that's nice to see that there is something in that notice specific to using a high cost percentage multiplier. That should help us get some more construction and sub rehab loans off of being statutory constrained, or certainly make them more attractive to the borrower. That's it. It's been an exciting day. Hey, remember folks, when rates move up, they do move up faster than they fall. So if you are in a good spot on your property and the cash flow is meeting your business plan and your requirements, always take that lock rather than wait. I've just seen folks try to wait for them to come back down. And while it may happen, clearly nobody has a guarantee on that. And when the market really did fall apart early in March, we did see traders just adding spreads to their margins. So didn't really pick up that benefit in the interest rate until more recently. So again, remember, in the mortgage market, those rates do move up faster than they come down. So pay close attention, follow your business plan, get out there and get some deals done. I hope you all have a great weekend. I'll be reporting live from Miami Beach, Florida next week on Rate Desk. Thank you for tuning in to another edition. This is Michael Thomas signing off.